Hi, welcome to my screencast on the inventory costing method of LIFO. So what is inventory costing? Inventory includes raw materials, work in progress and finished goods that a company has available on hand for manufacturing purposes or to sell to customers. Inventory is considered an asset, so must consistently be recorded by a valid method of inventory costing. The accounting method used to assign cost to inventory has a direct bearing on the cost of goods sold within an accounting period, and consequently the profit or income made. The basic formula for calculating the cost of goods sold is beginning inventory plus purchases minus ending inventory. Therefore, the cost of goods sold is directly a result of which inventory costing method is chosen by the company, as ending inventory would vary for each method. There are 4 different inventory costing methods. They are specific identification, moving average, FIFO and LIFO. Specific identification refers to the tracking and costing of inventory based on the movement of specific inventory items. This method is valid when individual items can be clearly identified, such as a VIN number on a car or jewelry at a store. If specific identification is chosen, companies will be able to report inventory for the specific cost of an inventory item when it is sold. The moving average method calculates cost of goods sold from the average unit cost of all inventory items available for sale. This is determined by the simple formula of average unit cost equals cost of goods available for sale divided by the units available for sale. FIFO calculates the value of inventory on hand by first selling the older stock available for sale. Thus, the cost of older inventory is assigned to cost of goods sold and the newer inventory is assigned to ending inventory. This is such in the sales of TVs. The newer models will remain full price, while the older stock may be placed on sale price in an attempt to get rid of the older stock. Lastly, LIFO is the method for which cost of goods sold is determined on the assumption that the last unit of inventory purchased or manufactured is the first unit sold. LIFO is not within international financial reporting standards. Although it is permitted by US GAAP, LIFO is banned in Australia and most other countries. For example, think of a bakery. 100 loaves of bread were baked on the 1st of October for the unit cost of $1 each. The next day, 100 more loaves were baked at the unit cost of $1.50 each. The cost of goods may have risen due to a change in supplies prices, the amount of labour required, an increase in taxes, or a rise in freight costs. In this situation, the baker could use the LIFO method and sell the freshest, newest loaves on the 3rd of October, while using the remaining $1 loaves to report the ending inventory for the period. This would lower his taxes considerably by understating his profit and income. Thank you for watching.
Created using Powtoon.